Hi everyone! Recently, the Hang Seng has come under pressure again, and some Chinese stocks have been hit much harder than the index itself. So in this video, we'll look at where this weakness is coming from, what it says about the Chinese economy, and whether some indicators still give us some reasons to hope. When we look at Chinese equities since 2021, I deliberately start after 2020 because 2020 was too distorted by COVID. Chinese equities have been very disappointing compared with other major markets. Since the end of 2021, in US dollar terms, the S&P 500 is up around 54%, the Stoxx Europe 600 is up around 32%, and the Topix is up around 41%. Over the same period, the Shanghai Composite is only up around 11% in local currency, the CSI 300 is slightly negative, and the Hang Seng is still down around 3%. So this was already a difficult period for Chinese equities in general. But since 2025, the divergence has become much more visible. The Hang Seng has fallen sharply from its 2025 rebound, while mainland indices have held up much better. A large part of the explanation comes from the composition of the Hang Seng itself. Among the biggest weights, there are many financial companies: HSBC, AIA, China Construction Bank, ICBC. These names have generally been much more resilient. But the index also still has a large exposure to internet platforms, e-commerce, software-like companies, and consumer-related names. And these stocks have heavily underperformed since 2025, even though they are still a big part of the index after the correction. Here, the pattern is not completely different from what we have seen in Western markets, especially in the US. Investors have made a clear distinction between AI hardware stocks and software stocks. A lot of money moved towards semiconductors, infrastructure, data centers, and companies directly linked to the AI capex cycle. Software stocks were punished much more, consumer discretionary stocks also suffered, but the move has been more brutal in China. The same logic appears when we compare the Hang Seng Tech Index with a mainland semiconductor proxy. Since early 2026, the performance gap has widened a lot. Capital has moved toward mainland semiconductor stocks, AI hardware and strategic technology themes, while Hong Kong platform stocks have remained under pressure. Personally, I think this rotation is partly driven by a real industrial trend. China wants to build more domestic semiconductor capacity, and AI infrastructure is becoming strategic. But I also think valuations are now heavily distorted in some parts of the AI hardware trade. We can see the same thing in the US market. The narrative is powerful, the momentum is strong, and investors are willing to pay very high multiples for companies directly linked to AI infrastructure. The difference with China is that the large platform companies have not been treated like the US megacap platforms. In the US, the largest technology companies have kept strong market support. In China, the equivalent platform names have been heavily punished. Part of this discount is fair. The risk of disruption is real for some software companies. Chinese platform companies probably also have less room to monetize AI than the US leaders. But in some cases, I think the correction has gone too far. Some of these companies still have attractive valuations, strong cash flow, large customer bases, and very valuable data on their users or clients. This data can help them improve their products, add AI tools more efficiently, and protect part of their ecosystem. That's why in my previous Tencent video, I said I would probably add gradually to my position, given the current valuation that I find attractive. Now, beyond the question of flows, we need to look at one of the best-known structural problems behind the fragility of Chinese equity over the last few years, the property crisis. I see three main reasons behind this crisis. The first one, and probably the most important, is the evolution of mortgage credit. Real estate prices are closely linked to the ability of marginal buyers to buy a property. And this ability depends a lot on access to bank credit. This is true in China, but also in Europe, in the US, and even in countries like France, where people often say that real estate is always a safe investment. In reality, if banks decide, for any reason, to reduce the flow of mortgage loans, the market can change very quickly. Buyers lose purchasing power, transactions slow down, and prices come under pressure. This is what happened in China after 2021. Before the crisis, outstanding personal housing loans were growing very quickly. They increased from around 14 trillion RMB in 2015 to almost 39 trillion RMB in 2022. But after that, the growth stopped. Since 2021 and 2022, the amount has been broadly flat, and it has even started to decline slightly to around 36.7 trillion RMB in Q1 2026. Part of the explanation comes from the redirection of bank credit. China has pushed more financing toward industry, manufacturing capacity, strategic sectors, and technological self-sufficiency. The goal is clear. China wants to become more self-sufficient in as many key sectors as possible. The second explanation behind this property crisis is the economic and sanitary context. The COVID period, and especially the long lockdowns in China, damaged confidence, employment expectations, and household behavior. The third explanation is valuation. Before the crisis, property prices in many Chinese cities were simply too high compared with income. And even today, after a large correction and after several years of income growth, affordability remains difficult in many cities. In some places, prices have fallen by around 30%. But when we compare the price per square meter with the average monthly salary, China still looks expensive compared with countries like Japan, France, and the United States. So when mortgage credit stopped growing, the starting point was already fragile, and this is when the model started to break. The first consequence for Chinese households was a negative wealth effect. Like in France, a large part of household wealth in China was tied to real estate. But in China, this was even more visible because property was often used for several purposes at the same time. A place to live, an investment, a retirement asset, or sometimes a way to prepare housing for children. On the chart, housing and real estate represented around 50% of household assets in 2020 and 2021. Since then, the share has declined every year to around 36% in 2025. This decline is quite natural. When property prices fall, the weight of real estate in household wealth falls with it. At the same time, households have increased their precautionary savings, especially deposits and cash. We'll look at this in more detail later because it is one of the links between the property crisis and weak consumption. And the crisis is still far from over. Property inventory remains very high. Floor space for sale increased from around 498 million square meters in 2020 to more than 770 million square meters in 2026. The months of supply moved from around 3.4 months to more than 12 months. Even if demand improves a little, there is still a large stock to clear. The same weakness appears in real estate investment, sales, new starts, and developer funding. Since 2022, most of these indicators have remained negative. In the first months of 2026, real estate investment was still down around 16%, developer funding was down around 19%, and new starts were still down more than 22%. There are some signs of stabilizing in the largest cities, especially in Tier 1 cities, but the national picture is still weak. The 70 city data confirms this. In May 2026, for new homes, prices were still falling in 52 cities, while only 16 cities were rising. For second-hand homes, the situation was even weaker, with 57 cities falling and only 10 rising. This situation is especially problematic because the property crisis has affected several generations at the same time. For millennials, the shock was probably the most painful. Many of them bought apartments at very high prices, often with large mortgages. In some cities, after the correction, part of this generation ended up with a property worth much less than expected, while the mortgage was still there. For some households, the remaining loan even became close to or higher than the current value of a property. Psychologically, this is a very difficult situation. When people feel trapped between the debt they still owe to the bank and the lower market value of their apartment, it changes their behavior. The Chinese government tried to reduce the pressure by lowering mortgage rates. New mortgage rates moved from around 5.6% at the end of 2021 to around 3% today. This helped monthly payments. But for people who bought near the top, lower rates do not erase the loss of wealth. For Gen Z, the situation is different. They are not necessarily already trapped in expensive mortgages, but they face a weaker job market, especially in large cities. The official youth unemployment data is not perfectly comparable over time because the methodology changed, but the pressure remains visible. For young people, buying a home, getting married, having children, or making large purchases becomes more difficult. For older households, the impact is also important. Some people close to retirement bought extra apartments as an investment or as a way to prepare for retirement. When the value of this property falls, the feeling of wealth falls with it. So, across several generations, a large part of the population has seen its perceived wealth decline. And this leads directly to the next behavior. Chinese households are trying to repair their balance sheets. They save more, invest less, and become more careful with consumption. On the depositor survey, the share of respondents who prefer more saving remains very high, around 63% in Q4 2025. The share who prefer more consumption is much lower, around 22%, and the share who prefer more investment is only around 15%. So the property crisis starts with housing, but it doesn't stay there. It hits household wealth, then confidence, then consumption. And this is the next part we need to look at. Now we can move from real estate to consumption. The macro chart gives a good summary of the situation. The industrial side is still working. Industrial production is still growing, around 4.5% year-on-year in the latest data. Exports are much stronger, close to 19%. So the export machine is still there. China remains very competitive on the industrial side. Retail sales tell a weaker story. After the rebound in 2021, linked to the recovery after the first COVID shock, the trend became much more disappointing. In the latest data, retail sales are slightly negative, around minus 0.6% year-on-year. This is why the Chinese economy feels so unusual today. Factories are still running, exports are strong, and yet the domestic consumer remains fragile. The income chart gives another way to see it. Real disposable income is still growing. In Q1 2026, it increased by around 4% in real terms. Real consumption expenditure grew only around 2.6%. So households still have income growth, but they are spending less of it. A larger part goes into savings. This fits with what we saw earlier after the property crisis. Households are trying to repair their balance sheets, rebuild precautionary savings, and avoid large financial commitments. The retail sales by category chart makes the situation more concrete. Over 5 years, many categories still look positive, but the comparison starts from a distorted COVID period. The recent trend is much weaker. In 2026, the weakest categories are motor vehicles, building materials, home appliances, and furniture. These categories depend on housing, confidence, and large purchases. When people buy fewer apartments, renovate less, or feel poorer after the property correction, they naturally spend less on cars, appliances, furniture, and decoration. This is also why many e-commerce and consumer-related stocks have been under pressure again. In 2025, there was a beginning of improvement. The market started to believe again in a gradual recovery of Chinese consumption. Some e-commerce names, platforms, and consumer stocks rebounded because investors were starting to price a better story. Then the war in Iran arrived at a bad moment. In China, the effect was not necessarily immediate through fuel prices, because the government can smooth part of the shock with price caps and administrative measures. But the psychological impact can come much faster. When households see a war outside, higher oil prices, and new inflation risks, they become more cautious. Even if the full impact doesn't appear immediately in official prices, people can change their behavior quickly. They delay purchases, keep more cash, and save in case the situation gets worse. For a consumer already weakened by the property crisis, this kind of external shock is enough to slow the recovery again. This is visible in the market reaction. In 2025, investors were ready to believe in a consumption recovery. Since the beginning of 2026, the story has become more difficult again. Retail sales weakened, confidence remained fragile, and the Iran shock added another reason to stay cautious. Of course, every company is different. JD.com is not Alibaba, Alibaba is not Tencent. Some companies have cloud, AI capex, advertising, or margin stories that can change the investment case. But for the Hang Seng, the general direction remains difficult. The index still has a lot of exposure to platforms, e-commerce, and consumer confidence. For now, the recovery that seemed possible in 2025 has been delayed again. So at this stage, the question becomes more about timing. Real estate prices and consumer confidence are strongly connected. I don't have a crystal ball, and I won't pretend that I know exactly when the Chinese property crisis will end, but we can still look at previous real estate crises to get an order of magnitude. History doesn't always repeat, but it often rhymes. On this chart, we can compare China with previous property crises in the US, Spain, Ireland, and Japan. For the US, Spain, and Ireland, real house prices generally bottomed around 5 to 6 years after the peak. The path was different in each country, but the worst point came roughly in the same zone. China's property crisis started around 2021. Today we are roughly 5 years after the peak. Based on these examples, China may not be very far from the period where the decline starts to slow. Of course, this is not a precise forecast. China has its own issues, especially high inventory, demographic pressure, and a very different policy environment. I also put Japan on the chart, but personally I don't use Japan as my main comparison. The Japanese real estate bubble was an extreme case. At the peak, prices per square meter in some parts of Tokyo were around 350 times higher than in central New York. China also had very expensive real estate before the crisis. And even after the correction, affordability remains difficult in many cities. But the Japan comparison feels too extreme to me. For me, the more relevant examples are the US, Spain, and Ireland. And from that perspective, China may be getting closer to the end of the most violent part of the correction. The second chart looks at consumer confidence. Here again, the recovery takes time. After a property crisis, households do not regain confidence immediately. They need several years to absorb the shock, rebuild savings, and feel comfortable again. For China, the fall in confidence has been very sharp. The latest level is still extremely low compared with the pre-crisis period. But we are now entering the 5 to 6 year window where in several previous crises, confidence started to improve. I wouldn't say that the recovery is already here, but the timing is becoming more interesting. If property prices start to stabilize, even without a strong rebound, the psychology of households could change. To conclude, the decline we've seen in the Hang Seng Index is linked to several factors. Part of it comes from flows that have moved away from software-like companies, internet platforms, and Hong Kong-listed names toward mainland China stocks linked to AI hardware and semiconductors. For Chinese platforms, the AI capex narrative is not necessarily positive for the market. Competition will probably be intense between all these companies investing in AI, and the return on investment is still very uncertain. So investors see higher capex, pressure on free cash flow, and they apply a correction to these stocks. For e-commerce, discretionary consumption, and consumer-related stocks, the issue is more linked to confidence. As we saw earlier, consumer confidence collapsed after the property crisis. In 2025, there was a first sign of improvement, and the market started to price a recovery. But this improvement was interrupted again, especially with the war in Iran. External shocks like this are almost impossible to predict, but outside these shocks, the recovery in confidence will mainly depend on the ability of the Chinese real estate market to stabilize. And not only in the biggest cities, but more broadly across the whole market. One positive element is the household balance sheet. Chinese households have saved a lot in recent years, and they are still saving a lot. We can see it very clearly on this chart. Household deposit increased massively from around 93 trillion RMB in 2020 to more than 173 trillion RMB in March 2026. Part of this increase is structural. The Chinese population is aging, and because the pension system is not as developed as in many Western countries, households need to save more for retirement. But a large part is also linked to the psychological impact of a property crisis. When the value of real estate falls, households try to rebuild their balance sheets. They keep more cash, they save more, and they take less risk. The difficult question is how far this can go. But at some point, Chinese households will probably do something with this surplus of savings. I don't think all of it will go back into real estate. After this crisis, many households will probably remain cautious with property. Part of the money may go into precious metals like gold or silver, part of it may go into Chinese equities if confidence in the market improves, and I think a significant part could also return to consumption. Thanks for watching this deep dive until the end. If you found it useful, feel free to like, subscribe, and share.